What's going on, guys? It's Justin from Push and Profit. Hope you're having a beautiful day today. Now, it's a very well-known fact that trading options generally provides larger percentage gains than trading stocks. So you might start thinking to yourself that maybe it's in your benefit to trade options. However, in this video, I want to break down the risk of trading options that, many new traders don't consider. Now, in no way, shape, or form is the purpose of this video to discourage individuals from trading options. And in fact, it's actually the opposite. And the objective of this video is to help you decide if you should trade options and also just explain some factors that you need to consider if you want to become a profitable options trader, right? Now, here's the big difference from trading stocks and trading options, right? When someone is trading stocks, they are interested exclusively in the direction in which the market will move. So if you're going long on a stock, you're buying low and you want the stock to go higher so that you can sell. And if you're going short on the stock, you're selling high and you want to buy the stock lower and make a profit. It's very plain, dry, and simple. And your only concern is the direction of the market. Now, an options trader is also sensitive to the directional considerations, but he must also give some thought to how fast the market is likely to move. So if a trader and a stock and an options trader, enter in the same market taking long positions and their respective instruments, and the market does in fact move up higher, right? The stock trader is assured a profit. It's guaranteed, while the option trader might still show a loss. So if you buy a stock at $5 and you sell it for $10, you're guaranteed a profit, guaranteed, right? However, if you buy a call option with a strike price of $10 while the underlying stock is $5, there's a chance where the underlying stock can hit that $10 strike price and the options trader lose everything, right? Now, this is because options have multiple moving parts and they also have expiration dates. So if the market fails to move sufficiently fast, the favorable directional move may not be enough to offset the option's loss in time value. And that's again because, of the multiple characteristics in an option. You have the Greeks, and then you also have other, the expiration date of the option. So often what I see is, individuals will want to buy call options for the seamlessly favorable risk reward characteristics where you have limited risk and unlimited reward. But if someone purchases a call option, not only must they be right about, the market direction, but they also got to be right about the market speed in which it goes in that direction. So only if a trader is right on both counts can the trader receive a profit, right? So if you're someone that thinks that trading is difficult because you have to predict the correct market direction, then you're going to find it, really beyond your capability to trade options because you have to correctly predict the direction and the speed in which the option reaches that direction. And that's because of the concept of speed, it's very crucial to trading options. So if you're a trader and you're highly proficient at predicting directional moves, then it's probably better advised to just trade the stock, right? Now, only when a trader has some feel for the speed component can they hope to successfully enter into the stock market or the options market. Now, as I mentioned, there's going to be a few scenarios when you trade options where, the underlying stock is going to go in your direction, but because of this time it took to go in that direction, or it wasn't in your favor, you could possibly lose. So again, going back to, the stock, right? If you buy a stock at $50 and it goes up to $100, right? And maybe like 3 months, it doesn't matter. You made a profit, right? Now, let's go ahead and take this into the option contract, right? So let's say the contract, right? The strike price was $100 and you bought it when the stock was $50. Now, you could have a contract, they have different dates, expiration dates. So let's say you buy the contract and it's for next month, right? Now, what happens is often with options, the underlying stock might not hit that strike price of 100 till after the expiration date, right? So to better kind of explain this, you might have a stock that goes from 50 to 100, but it might take 2 months. But you bought an options contract that it was going to go from 50 to 100 in 1 month. So let's say you buy that option contract, when it was $50 and the strike price was $100. If it doesn't touch that $100 by the expiration date, guess what? Your option is literally worthless, right? It's worthless. Now, again, with options, you could day trade them where you don't have to have it hit that strike price and you could sell before it hits that strike price and make a profit. But that's just one example of how, with options, it doesn't matter if it hits 100 later on. The option could expire way before the underlying stock hits that strike price. So that's one scenario. Another scenario can be with IV crush, right? Now I'm not going to go too detailed or too in depth with IV crush. I think that deserves a separate video. But there could be a time where the fellow YouTuber by Patrick Weiland, he one time traded his first option, and he was talking about how he lost, and he wasn't sure how he lost.
Really screwed up here buying puts on ITCI. I thought I was a genius. I thought I was going to get rich.
And really the real reason why he lost was because he bought a stock that pumped up, right? And he bought puts on it, right? But the problem was that the puts that he bought were so far out of the money, and the stock had a big, flush of IV, implied volatility, while it was pumping up. And then as it was selling off, the stock did drop like 50%, but he didn't even make a single dollar on his option. And that was literally because of IV crush, where, because of the implied volatility going down, the premiums for the options were going down. So, that's just, two simple scenarios on how, when it comes to options, it's much more than just a directional trade. You got to factor in so many different moving particles, right? To piece it all together. Options is like a moving mechanical instrument. So that's why options is a lot more difficult than trading stocks. And that's why, if you're just someone who's only good at directional, transitions in the stock, then, you should just stick to trading stocks. But if you're someone who could, accurately get the, direction with how long it could go in that direction, then options is going to be for you. Options is leverage, and you're probably going to make more percentage wise, right? But at the end of the day, it's all up to you. I recommend anyone who even gets or wants to get into options, either do it two ways. Either paper trade, right? But let's be honest, a lot of people don't like paper trading anyways. And then once you finish paper trading, use real money, but use a small amount. Because with options, there's gonna be so much that you're gonna have to learn that it's gonna take a while for you to actually get it. So with that being said, guys, my name is Justin from Push and Profit. Hope you enjoyed this video. Make sure to hit that like button if you really learned anything new, or if you just want to support the channel. Also, to support the channel, you could consider checking out the links in the description below, because one of the links is going to be a link to my free Facebook group, and it's essentially a group of investors or traders that are interested in learning how to trade and invest in the stock market. And, it's a free Facebook group, so why not join it? Also, consider hitting the second link in the description below. It's going to be a link for Webull, where if you sign up with that link, you'll receive a free stock. And you never know what free stock you're going to get. When I first signed up with Webull, I got a free share of Google, which at the time was worth $1,200. Now Google's worth like $2,000, but when I first got that free share, it was $1,200. I even have a whole video on that. You could look for that somewhere in my channel of me getting that free stock. But with that being said, guys, hope you guys really enjoyed this video. Hopefully this video helps you to better understand a little bit more about options, and hopefully it helps you make that decision of whether or not you should get started in trading with options. Again, guys, my name is Justin from Push and Profit. Hope you have a beautiful day, and I'll see you on the next video.